withdraw from your 401k too soon, and you could lose up to 30% of that savings instantly. Yep. The IRS, they call that a penalty. I call it a preventable mistake. So let's dive right into it, folks. Let's talk about one of the most misunderstood parts of retirement planning, the IRS early withdrawal penalty. If you take your money out, everyone, and from a tax deferred account like a 401k or traditional IRA before 59 and a half, the IRS will hit you with a 10% penalty, and that's on top of your regular income tax. So if you're in a 22% tax bracket, you're actually giving up 32% with that withdrawal, meaning for every $10,000 that you're taking out, you may only keep $6,800, $6,900. Now that's a lot of money lost to timing. Not bad investing, just bad timing. So let's dive into that, folks. I've seen it a lot. I've been licensed for the last 10 years in the financial industry, and one of the main reasons why this is happening is because most people just go with the flow. The government gives you a tax break on the front end. So when you start contributing to your 401k or your IRA, they let your money grow tax deferred. And you do that for decades. You just tax deferred, tax deferred. But in exchange, they're expecting you to leave it alone until your retirement. That's why the Section 72T of the Internal Revenue Code, it discourages pretty much early withdrawals. So your savings stays intact when you need it the most. And yet, millions and millions of Americans, what do? We dip into these accounts every year. Sometimes they're for emergencies, right? Sometimes it's for a home purchase. You want to get a new house. Sometimes because they didn't know that there were other options out there. They have a hardship. People are dipping into these accounts. Well, according to Fidelity, last year, nearly 1 in 3 workers between the age of 35 and 55 have taken a premature 401k withdrawal, and over 92 billion has been withdrawn from these retirement accounts every year. And most of that was penalized. They're paying these penalties. So the question is, what's the real cost? Okay. What's the real cost for you and early withdrawals? Well, let me give you an example. I actually had a client. All right, very simple. They had $50,000 in an old 401k and they wanted to cash it out early because they switched their job. And then look, I need some money real quick. They were at that 22% tax bracket. So that's $11,000 for federal income tax. And then there was a 10% penalty. So another $5,000 was gone. So instead of my client having $50,000 to walk away with, they had right around $34,000. So they just gave up $16,000 just due to taxes and penalties. That's why that IRS penalty trap is really, I tell folks, it's not about greed or complexity. It's all about most people don't know the rules. So how do you avoid these rules? How do you avoid these traps? Well, the good news is this, folks. It's very simple and it's 100% avoidable. 100%. If you're leaving your job and you don't want to cash out your 401k, you could do a direct rollover instead. All right. So, and that's under the IRS section 402C, you have a trustee to trustee rollover that lets you move your retirement funds directly into another qualified account, like an IRA, like a fixed index annuity, without triggering all these taxes and penalties. Now, the one small step that makes it all the difference, one small step, you stay tax deferred, so you stay compliant. That's fine. All right. And your money keeps compounding instead of shrinking. That's perfect. So you're still getting all those things in place when you have it, but it's because you're doing it direct. Now, what is that direct rollover? That's a huge question. So think of it this way. You have indirect and direct. And the indirect, the check comes to you and the IRS assumes you're going to withdraw that money. That triggers that 20% withholding automatically. But with the direct, that's indirect. But with the direct rollover, okay, the money goes straight from the old plan to your new plan without you never touching it. And since you're not touching it, the IRS never taxes you. That's huge. That I say is the clean, compliant, penalty-free way that you could actually move your money without worrying about the cost, the headaches, all those things. Now, a lot of times my clients, they use annuities, and they want to use annuities for tax control from old 401k. So when you switch everything over into a new home like an IRA or a fixed index annuity, your savings could keep growing tax deferred until you're ready to use them. That's huge. Now, here's why it matters, folks. You're not just deferring your taxes, you're gaining control over when and how you pay them. So it's control that you want to have. So what can you do when we talk about control? You could plan withdrawals, right, during lower income years. So you could use systemic income options to spread taxes over the time. So not just a one time, you could spread it. Or even plain partial conversions when the rates are favorable. All right, so you could do that. And while all that's happening, your annuity is still compounding. It's still protected from market downturns. A lot of my clients use them because you have a floor so you don't lose money. And that's what a smart tax deferral plan really looks like. Keeping your money growing, uninterrupted, and that tax bill under control. Okay, so what are expectations, guys? What are expectations you should know? I tell people there are pros and there are cons and there are exceptions. Now, the exceptions to early withdrawal penalties, right, and to know if they're worth knowing and to keep on these strategies is the IRS allows penalty-free withdrawals before 59 and a half for certain reasons, all right, which is disability, medical expenses above 7.5% your income, qualify first-time home purchases, which is up to $10,000 from IRAs. You can have substantial periodic payments under that Rule 72T. And then in some cases, separation from services after 55. They call that an in-service distribution. So there are a couple things you could do. But here's the key. Those exceptions, they're very small. They require precise documentation, and simple mistakes could trigger huge taxes and penalties. So if you're thinking about tapping into your retirement funds early, always check first, okay? Because once the IRS flags it as a distribution, there's no undo button, and it could cost you a lot, all right? So I always tell people it's like having a real world impact. Let's break it down. Let's say you got two people, all right? Person over here, person A, person B. Person number A, they cash out $100,000 from their 401k at age 50. Person B rolls it into a fixed index annuity instead. So if one person cashes out, one person's an annuity. Person A loses $32,000 in taxes and penalties right up front. Person B keeps that full $100,000 compounding tax deferred. So if that money grows at, let's just say 5% annually, person B will have right around $162,000 after 10 years of saving. Meanwhile, person A would have to earn 9% per year just to catch up. So sometimes you hear people saying you get a higher amount, but you have to have 9 just to catch up to a 5%. That's the power of avoiding penalties and deferring taxation properly. So I tell people it is what? Structure. So now let's talk about protecting your retirement freedom. And that's huge. You worked for your entire life, right? Now you built up a retirement nest egg. Don't let a single mistake undo years of discipline, okay? By understanding when and by understanding how to move your money, you can stay in control, not the IRS. That's a huge mistake. You get to choose your timing, your structure, the income strategy that fits your specific retirement goals because you're in control, not the government. All right. And if you're not sure where to start, look, guys, that's okay. That's what professionals are there for. Your accountants, your CPAs, financial advisors, people like me. We're here to navigate you to make sure you can have it safely, confidently, move your money where you're not worrying about it. But guys, this is huge. And I tell people this is something a lot of folks don't think about. They just automatically, boom, let's touch that money. Boom, we're going to have penalties, taxation, 10%, whatever. I need it. Since people need it, a lot of times is what? When people start thinking, irrationally, I got an emergency. I have nothing else. Let me dip into these retirements. They take that, not considering the taxation and penalties. So make sure that you need to have an emergency fund. You need to have, high yield savings accounts that you have liquid access to, so you don't have to worry about touching these kind of things. So avoiding these penalties, they're not complicated. It's just about knowing the right process and having everything pretty much in play. There's rules. You need to understand those rules to make them work for you, to make sure they're not working against you. Because a lot of clients, like I said, I've been licensed for the last decade. A lot of people just don't know the rules, man. And you don't know the rules, that's what really hurts you. So if you're thinking about touching an old 401k, all right, pause before you actually take a withdrawal. Make sure you're not handing out thousands of dollars unnecessarily in taxes and penalties to the IRS, all those kind of things. And if you guys want some help, you can reach out to me, check the description. You could schedule a consultation, get a quote. We'll walk through all the options step by step and see if a tax deferred rollover or an annuity is a strategy that makes sense for you, because not every strategy works for everybody. You need to make sure that it works specifically for you. So if you guys found this information valuable, make sure you like, subscribe to the channel. Always follow back, and I'll see you on the next one.